I've definitely have had borrowers that have called me and like, hey, I can't make my payment.
What's that like?
I mean, you just try to give them as good of advice as you can, you know. Um, if
You tell them to sell some stuff?
I mean, I tell them to do whatever you can to make the payment.
Yeah.
Do whatever you can to make the payment. Oof, because
it's hard.
Mortgage rates are really painful on credit.
Like how painful?
Significant, very significant.
How many points we talking here?
A mortgage late.
How many points?
It's hard for me to say exactly, but
take a guess. I mean,
30,
they're
50,
not going to fact check us. No one's listening.
30 points, 50 points.
Oh, I think it's probably. I bet it's closer to 65.
Maybe, yeah.
They slap you for disrespect.
Because the other thing is like
they said you agreed to this, and now you don't pay.
Wham!
Boom.
Yep, you get the credit,
and then you start crying.
The credit backhand, the Experian karate chop.
It's nothing like going to buy something on credit after you missed a payment.
Oh man, yeah. I the other thing too is like if you're borrowers that are going into foreclosure, the last thing you want to do is talk to the lender, like talk to the servicer. That's like the number one thing you should do. Is have communication.
What do you got to lose?
Have communication with whoever holds the loan, because for the most part they're going to want to work with you. Because a foreclosure again is very expensive for the lender. It's not what they want to do in most cases, But yeah, that's a tough. I mean, that's a super tough conversation, because like you a lot of times it's just they can't make the payment, and there's nothing else they can do. Well, I mean, the good thing is right now it's like with home values increasing, it's like they could probably sell. If they bought a house a year ago, they could sell the house and be fine, right? But there are times in the past where it's like you had a short.
Depends on their agent,
right?
Yeah, I mean, the highest I've seen in 1 year was this year, $180,000. $180,000 in a year
on
Garbett homes.
Is that the average?
Off Winchester? No. It all depends on the house.
But that's what you've seen on one particular house.
Yeah.
That you help.
Yeah, that was the most I've ever. But I hesitate with that too, because I've seen some flips. But to clear that, I mean, it's like a big deal.
Yeah.
I mean, you just don't. It's very rare. Very rare. But this is what I would tell them if they called me. I would say, you better call whoever you need to, whoever you get your statements from, and let them know and work it out right now, because you've got nothing to lose. Because if you don't, then you're still right where you are right now.
Yeah. Yeah, no, and that's the thing. Like the train's gonna leave the station whether you.
So who takes the house on
are
VA
talking to them or not?
Veteran, who takes that house?
Well, see that's the thing is that, the VA really has nothing to do with the actual lending of the money.
Because it's insured.
Well, the VA guarantees the loan. So the difference between FHA and VA is that FHA has an insurance, right? They have their own mortgage insurance. The VA has a guarantee, and they're guaranteeing a certain portion of the loan amount for the lender, so that if the veteran defaults, they pay a claim to the lender to help them with the default. So every loan that's done is bought by some investor. So it could be like Credit Suisse, right? Credit Suisse is a big buyer of loans. I mean, but I mean, anyone, like you'll get bought by like PennyMac or
hedge funds.
There's a million companies that will buy the loans, and they could also be backed by hedge funds. And so
shell companies,
maybe. I mean, I think there's plenty of servicers that are like that, where they have a lending side and then a servicing side, But if you foreclose on a VA loan, that's being held by some bank. It's not being held by a VA. So if you foreclose on a house, that investor takes the hit. They get paid a claim from VA, right? They get paid because it's guaranteed, but the investor that holds the loan is still on the hook for it.
It's got to make sense though. Like the claim is good enough.
It's like the top 25% is what the guarantee is based on of the loan. And so, I'm sure there's some, at the very top when they're if you were to receive that payment from the VA for a defaulted loan, I've never seen that exactly. Can't really speak to that exactly, but that's what the guarantee is there for, is to pay for the default or help the lender in the default. And that's why they can do a VA loan for so much better on interest rate and pricing, because VA is subsidizing the risk with that guarantee.
Better than private mortgage insurance.
See, that's hard for me to say, because again, I haven't seen exactly what that looks like. Like, I haven't seen when the claim comes in, like what's it for exactly. But I think my assumption is that the VA guarantee pays better than private mortgage insurance, because the rate and pricing is a lot better on VA. But there's a lot of differences as to why that's the case, and it has to do with investors buying on the secondary market, what these loans are worth, and how they perform. Like there's a whole entire market for mortgage-backed securities that people that do loans, people that get loans, get mortgages, they have no idea about, and like that's what rates are based on, is like how much a package of mortgage-backed securities can be bought and sold for. It all comes down to a market, almost like trading stocks.